All right, we need to talk about what just happened because the markets, well, they just delivered a massive shock. Gold and silver, the assets everyone runs to for safety, they just went through one of their most brutal sell-offs in recent memory. We're talking about a record wipeout here. I mean, look at this. In just a single day, silver prices absolutely cratered, down a staggering 11%. And gold? It wasn't spared either, plunging over 5%. You gotta understand, this wasn't some gentle correction. No, this was a full-blown market meltdown. So naturally, the big question on every investor's mind is, what on earth just happened, right? Was this just random panic, or were there specific forces at play here? Well, that's what we're going to do in this explainer. We're going to break down the anatomy of this crash piece by piece. Okay, so first things first, let's get a handle on the sheer scale of this plunge. Now, this was a global event for sure, but to really see how dramatic it was, let's zoom in on a major market like India. They saw their biggest ever wipeout on the MCX, which is their main commodity exchange. It was wild. So let's just look at the raw numbers here. Globally, gold plummeted down to around $4,343 an ounce, and silver just collapsed, going from $84 down to just over $72. But if you look at the numbers for traders in India, wow, this was just brutal. We're talking a drop of 14,000 rupees per 10 grams on gold and a massive 20,000 rupees per kilogram on silver. These are the kinds of unprecedented moves that can wipe out entire portfolios in a single day. And you know what's crazy is that this crash didn't happen in a vacuum. Not at all. It came right on the heels of all-time highs. And that's the key here. Gold was soaring because of all that safe haven demand. Meanwhile, silver was being driven by huge industrial use. Think solar panels, EVs, the whole shebang. So when you hit a peak like that, well, it means the sell-off that follows, where everyone is cashing in their gains, is going to be incredibly severe. So if it wasn't just random panic, what actually caused this thing? Well, it turns out this was a perfect storm. It was a cascade effect created by 3 specific triggers that all hit the market at the exact same time. Let's break them down. So here they are, the 3 culprits. First, the exchanges suddenly made it way more expensive to trade. Second, the US dollar got a lot stronger, like really strong. And third, you had investors suddenly deciding, you know what, I'm going to take my profits and move back into riskier stuff. We're going to break down each one. All right, trigger number 1 was a bit of a technical one, margin hikes. The CME, that's the Chicago Mercantile Exchange, suddenly jacked up the amount of collateral traders needed to hold their positions. The best way to think about it is like this. Imagine your bank suddenly demanding a bigger down payment on a loan you already have. It's a huge shock, right? Well, this forced speculators, especially the ones using a ton of borrowed money, to sell immediately just to cover their costs. And that triggered a massive wave of forced liquidations that wiped out billions in a flash. Okay, next up, the US dollar. So whenever the Federal Reserve even hints that they might not be cutting interest rates as much as everyone expected, the dollar rallies. It gets stronger. And because gold and silver are priced in dollars, a stronger dollar automatically makes them more expensive for anyone buying with a different currency. And what does that do? It immediately crushes their appeal and pushes those prices right down. And the final piece of this puzzle was a big shift in market sentiment. You see, after this huge run-up in metals, investors started to get, well, a little greedy. They started looking over at the stock market and thinking it looked pretty attractive. So what did they do? They started selling their gold and silver to lock in those massive profits, and they rotated that cash right back into stocks. This just amplified the selling pressure like you wouldn't believe. So, all of this brings us to the next big question, the one I'm sure is on your mind. If the precious metals market can get hit this hard, what in the world does that mean for the broader stock market? And maybe more importantly, are metals really the safe haven we all think they are? So yeah, let's just ask it directly. If we see a major stock market correction, a big crash, are gold and silver actually going to protect your portfolio? Well, the answer? It's a little more complicated than you might think. See, in a full-blown equity panic, let's say a 20% crash, history shows us that gold and silver don't escape the damage, at least not at first. The reason is something called forced selling. When the big funds, the pension funds and the algorithmic traders, need to raise cash and they need it fast, they sell everything. They sell their winners, they sell their losers, it doesn't matter. And that means even the so-called safe havens get dumped. We typically see metals correct by 10 to 20% right alongside the stocks. And this is a really crucial difference this time around. Unlike the 2008 financial crisis, both gold and especially silver are facing pretty significant supply deficits. There just isn't enough of this stuff being mined to meet demand. So this strong fundamental backdrop could actually act as a floor, It could limit how far the prices can actually fall this time. Okay, so that's the story of what happened and why it happened. Now, let's look forward. What can investors expect from here on out? Well, it looks like we're looking at a tale of two timelines, some potential short-term pain versus some massive long-term potential. So in the short term, yeah, you should probably expect some choppy waters. More dips are definitely possible as all that speculation gets washed out of the system, so you're going to want to watch those key support levels. But the long-term outlook? Oh, that remains super bullish. That supply crunch we talked about is real, industrial demand is booming, and you've got central banks all around the world just continuing to buy gold hand over fist. And look, this isn't just wishful thinking. This long-term bullish sentiment is being echoed by some major figures in finance. For instance, you've got investor Robert Kiyosaki, who's been on record for a while now saying he sees a long-term path for silver to eventually reach $200 an ounce. And he is definitely not alone. Major banking analysis is projecting a future where gold could be valued way up in the multi-thousands, and silver could hit $150 an ounce. And what's driving it? It's that same powerful combination we keep talking about, the industrial boom and that relentless central bank buying. So, the big question is, what does all this mean for you? We've analyzed the crash, we've looked at the forecast. So now, let's try and translate all this into a clear playbook with 4 key strategies you might want to consider. And of course, just a quick reminder, this is all for informational purposes. You should always do your own research. All right, so here are 4 key strategies to think about. Number 1, if you're a long-term holder, these kinds of dips could be seen as buying opportunities. 2, if you're more of a short-term trader, it's probably wise to just stay on the sidelines for a bit, until things stabilize. 3, for just about any portfolio, having about 10 to 15% in metals for diversification is a pretty sound strategy. And number 4, for our viewers in India, keep a very close eye on the union budget on February 1st. Any potential duty cuts there could really spark a lot of demand. And that brings us to our final thought for today. We've seen the chaos, we've unpacked the causes, and we've taken a peek at the forecast. So the big question I want to leave you with is this. After a crash like this,